Imagine buying a stock, checking your portfolio a few months later, and realizing the company's quarterly profit didn't just grow, it literally skyrocketed by over 107%. That is exactly what just happened with a relatively under-the-radar renewable player. While mainstream investors are busy chasing overcrowded mega-cap multi-baggers, this specific green energy stock quietly crossed an annual revenue of 2,654.5 crore rupees for the financial year ending March 2026. But here is the catch. Its stock price has been experiencing massive swings, bouncing across a wide 52-week window between 170 and 387 rupees. When a business grows this fast, it triggers a critical psychological shift in the market. Is this explosive growth sustainable? Or are retail investors walking straight into a beautifully packaged green energy trap? Let's look past the hype and unpack the hard financial truths. Let's look strictly at the official stock exchange filings to separate the internet rumors from cold, hard facts. In its recent quarterly financial results for the period ending March 2026, Fujiyama Power Systems, trading under the NSE ticker UTL Solar, delivered an absolute blockbuster performance. Operating revenue for the single quarter hit 900 rupees 0.77 crore, marking an 87.5% jump compared to the exact same period last year. Even more surprising was the net profit, which surged by 107.5% to land at 106.32 crore. Now, why did the stock react with such high volatility despite these numbers? It comes down to human behavior and market expectations. A big chunk of this growth was driven by the successful commissioning of their massive new manufacturing facility in Ratlam. When the market sees a company rapidly building large physical plants, some investors buy in immediately out of FOMO, fear of missing out. Meanwhile, institutional investors look closely at the massive 350 crore capital expenditure, or CapEx, recently approved for advanced TOPCon solar technology. They are asking a much tougher question. Can the company sell this massive wave of new inventory without destroying its profit margins? To understand how this company makes money, you have to look at what is sitting on top of modern Indian households. Fujiyama Power Systems operates primarily under its widely recognized commercial brand, UTL Solar. They don't just build large solar farms out in the desert. Their core business is heavily focused on the business-to-consumer, or B2C retail sector. Think of them as an electrical equipment ecosystem provider. When an everyday consumer decides to take their home off the traditional power grid, they need three main components: a solar panel to harvest sunlight, a solar inverter to change that raw power into usable household electricity, and specialized solar batteries to store power for rainy days. Fujiyama manufactures and sells all three. The genius of their business model lies in their distribution network. Instead of relying solely on massive, unpredictable government tenders, they have spent years building a retail network of local dealers and service centers across Tier 2 and Tier 3 towns. Every time a homeowner installs a UTL inverter to escape rising electricity bills, Fujiyama books revenue. It's a classic pick-and-shovel strategy. They aren't gambling on winning a single mega-power project. Instead, they are selling the vital tools needed for India's massive structural shift toward decentralized clean energy. Let's pull up the latest audited data from reliable financial databases to see how healthy this business actually is under the hood. Let's translate these numbers into plain English. Look at that return on equity of 49.33%. In simple terms, ROE measures how much profit a company generates for every single rupee invested by its shareholders. Touching nearly 50% is phenomenal for a manufacturing business. It shows that their factories aren't just burning cash, they are highly efficient cash-generating engines. Next, look at the operating profit margin, which recently climbed from 15% to 19% in their quarterly filings. This tells us that as the company produces more solar units, its fixed costs get spread out over a larger volume. This economic principle is known as operating leverage. However, notice the dividend yield is flat at 0%. For a conservative, income-focused investor, that might look disappointing. But for a growth-oriented investor, it makes complete sense. The company is actively reinvesting every rupee of profit directly back into the business to build out more manufacturing lines. Who actually owns this company? Examining ownership records reveals who holds the power. The core promoters maintain a stable controlling stake in the business. In the public market, this is generally seen as a positive sign. It indicates that the founders still have skin in the game and their personal net worth is directly tied to the long-term survival of the stock. When we look at institutional data, things get interesting. Foreign institutional investors, or FIIs, along with domestic mutual funds, have shown varying levels of interest over the recent quarters. Now, a lot of rookie retail investors make a classic behavioral mistake here. They assume that if overseas institutions are buying, the stock must be a guaranteed winner. But let's look at this portfolio through two different lenses. On one hand, institutional entry can mean the company has passed strict corporate governance checks. On the other hand, hot foreign capital can be incredibly fickle. If global interest rates change, these funds might dump their shares instantly, leaving everyday retail investors holding the bag. Always remember, institutions can afford to be wrong on a small mid-cap stock. Your personal portfolio likely cannot. So, what could realistically propel this company forward over the next few years? According to their latest stock exchange disclosures, the story boils down to three primary growth engines. First up is the massive capacity scaling at the Ratlam plant. Following its commissioning, the company's total solar panel production capacity has climbed to a massive 3,568 megawatts. In simple terms, more capacity means they can fulfill larger wholesale and retail distribution orders without turning customers away due to supply shortages. Second is their massive technology pivot. Management recently approved a 350 crore rupees capital investment to implement TOPCon manufacturing lines. If you're wondering what on earth TOPCon means, it stands for Tunnel Oxide Passivated Contact. Plainly speaking, it's a next-generation manufacturing method that allows solar cells to absorb more sunlight and convert it into electricity much more efficiently than older standard solar cells. By upgrading their tech, Fujiyama is aiming to future-proof its product catalog before older solar cells become completely obsolete. Finally, they are riding a massive regulatory tailwind. The Indian government's aggressive push for residential solar installations, such as the PM Surya Ghar Muft Bijli Yojana, is actively subsidizing home solar setups. Because Fujiyama's UTL Solar brand is heavily focused on the B2C consumer market, they are perfectly positioned right in the path of this massive wave of consumer adoption. But as an objective analyst, I have to give you the complete picture. No investment is a one-way street to wealth. And Fujiyama Power System faces real structural risks. The first major risk is intense competition and pricing pressure. The solar industry is notorious for brutal price wars. Massive global players, particularly from China, regularly flood the market with cheap solar components. If global panel prices plummet, Fujiyama could be forced to cut its retail prices to remain competitive, which would quickly shrink those beautiful 19% operating margins we looked at earlier. The second big risk is execution risk tied to their massive capital expenditure. Spending 350 crore on a technology transition like TOPCon is a massive financial commitment. If there are prolonged technical delays in setting up these new production lines, Or if a newer, even better solar technology emerges tomorrow, that capital could become stranded. When a mid-cap company ties up a huge portion of its balance sheet in physical infrastructure, it leaves very little room for operational errors. When we step back and look at the entire picture, Fujiyama Power Systems presents a classic high-growth, high-stakes scenario. On the positive side, you have stunning financial momentum, highlighted by a 107.5% jump in quarterly net profits, exceptional asset efficiency with an ROE near 49%, and a massive production footprint reaching 3,568 megawatts. On the negative side, you are looking at zero dividend income, heavy capital deployment risks, and an industry highly vulnerable to global commodity price swings and fierce technological obsolescence. This stock isn't going to fit every portfolio. For a conservative investor who relies on steady dividend cash flows or values predictable utility stocks, this business might feel way too volatile. However, for an aggressive growth investor who wants direct exposure to India's retail solar boom and is comfortable handling sharp price swings, this data offers a lot of interesting material to study further. But what do you think? Is Fujiyama's massive technological expansion worth the risk? Or do you think the intense solar price wars will eventually squeeze their margins? Drop your thoughts in the comments below. I reply to as many as I can. Don't forget to hit that subscribe button for more unbiased, data-backed stock deep dives. See you in the next video!